Welcome to Wise Beyond Bitcoin, where you come for the crypto, neo, news, education, and opportunities. My name is Lucas.
My name's Ryan.
I'm Jacob.
And we have a follow-up on, well, news, education, what's going on with blockchain, crypto, and regulation. We talk about education, but there's also a lot of talk about regulation. And it seems that there needs to be a little bit of a balance between the two, education and regulation. Maybe one, not put the cart before the horse, but it's good to see maybe where education can be of service before regulation. And then there are other areas which we can see clearly, even in blockchain, could use a healthy dose of regulation and oversight, being a bridge and connected to traditional financial institutions as they are. So, of course, this is not financial advice. This is not any type of legal or commercial advice. It's educational, entertainment, information. We're just sharing our research. Some of us have long hair, no sleeves, beards, ball caps, right? We've have various backgrounds in economics and finance and have been around blockchain and crypto for a few years. So we like to share our perspectives on where they come together. And with that, there are a lot of opportunities regardless. What you'll take away from all the news happening is that there is so much opportunity in this space, unlike anything before in our lifetime and probably our parents and grandparents' lifetimes, if you're listening to this at the moment, because we're talking about world leaders, bankers, central bankers, presidents, large institutions talking about this new thing, this new Bitcoin, this new thing called crypto, and how their countries and people will use it all over the world. You know, it's being adopted. It's decentralized, beautiful times, beautiful things, and beautiful playlists. If you'd like to do your own research and get started, you can support us many ways. One, hit the thumbs up, the like button, subscribe, follow us on Twitter and all that good stuff. And of course, if you would like to, for your tuition of learning, you'd like to send a little whale love, we've got the Krill donation addresses down below. And what else we got? I think that's about it. We ready to get started on this?
Yeah, let's jump in. So I guess we don't need to mention this, but we will just for coherence sake. But if you haven't heard, Luna Terra took a bit of a crash. It's been in the news. It's kind of a big deal. And
we actually made a video talking about,
let's mention that.
We made a video. It's in our playlist somewhere, but you can find it. We made a video talking about the Depeg before it happened. Didn't realize the probability of it happening, but we didn't understand the mechanics. So the idea is it happened. And for many people that wrote the article and have been around, that the mechanics gave way. It was just a matter of time. And the UST is a stable coin. So we're going to get into the talk of what is a stable coin, where does it fit in the role of blockchain and crypto. And so there's your education. And also, why should or shouldn't it be regulated? Where does regulation play in blockchain, crypto versus stable coins? And so I think hopefully at the end of this, you'll have learned something, at least hopefully we learned something as we talk it out and figure this out together. So, okay, you mentioned UST crashes, it's a stable coin. What's that all about?
Well, essentially what's going on here is that UST was a stable coin pegged at $1, and it was backed by Luna, another asset, which is part of the same protocol. And the way that this peg worked was that whenever UST was above the peg, above $1, then there would be this mechanism to where you could burn UST, mint Luna. Burn Luna, mint UST. Getting ahead of myself here. And that extra UST would then bring the value of UST back to that parity of $1. And the opposite happens when it trades below. There would be a way to burn UST, reducing its supply, making it more valuable, bringing its peg up. But that was also done by minting new Luna. So the real problem was that these two assets are highly correlated. So the way collateral should work is that when the collateral is needed, it's a safe haven, right? So like, for example, if you have gold, if you've got that backing your money and there's something that happens in credit markets and you need to turn to that collateral to make some of these liabilities whole, then the gold is probably, it's not part of the panic, right? It's a safe haven, it's separate. But if the asset that's collateral itself is connected to the problem, the panic, then you can find that your collateral just kind of disappears. And that's what happened with Luna. What happened is that as the peg broke and UST traded below its peg, more and more people burnt UST and minted Luna. And as the price of Luna fell, each subsequent burn minted more Luna, because every UST burn, every dollar of UST burned minted a dollar of Luna. But if the Luna price was falling, then the amount of Luna that's being minted is growing. Right. So it exponentially increased the supply of Luna, and to the point where Luna crashed all the way down to nothing. And that's essentially what happened. There was a bank run, and the collateral was way too correlated with the underlying asset, or with the liability of UST. And
which
that
is
created
different.
These dynamics.
It's funny you mention that, because that's a different kind of bank run, although bank runs have happened, and we've talked about bank runs and money in banking. And in the past, those bank runs happen not because of a lack of a correlation, but because overextended promises on
unlimited supply
of underlying collateral. Right. So in other words, if you had gold in the bank and you told people, well, I'll write you a note to represent this ounce of gold, just leave it here with me, and then writing a few extra notes on that same ounce, knowing that people are just leaving it inside the bank anyway. And then if a bunch of people come to claim that ounce of gold and there's been more notes written than the gold that exists, that's called the bank run. And the evolution of money in banking as we know it today, whether it comes through withdrawal limits and
severing the link between the collateral and the liability. That was a big one.
That absolutely first and foremost. But the bank runs have happened often, even in traditional markets. And to say that the collapse of the Luna stablecoin, one thing to mention about this is that the Luna stablecoin collapse, I think it made more newsworthy than actually it impacted the actual market. Because we were talking about this before the video, so we should mention it now that we're recording. But when you go back to traditional markets and the problems that are riddled in traditional finance, I mean, look at Enron, Lehman Brothers, the bubbles that exist now in housing and in student loans and in other areas of the economy, that when something really bad happens in these markets, it really ripples out and affects a lot of people's jobs, a lot of livelihoods, in a way that the crypto market itself doesn't impact as many people. And
when I would elaborate on that and how that happens in a highly regulated market, or to the extent where competition and innovation and new entrants are more or less limited, you start to get massive market shares. Like these companies that grow up real big. You're thinking of I'm thinking of Lehman Brothers, AIG, Goldman Sachs, Countrywide. You fill in the blank. We all know these names. And then what happens is they get to a certain point where they become too big to fail. The risk of them failing actually is too much, because the contagion effect, right? So if, like Lehman Brothers, when they failed, they had notes on their books that owed other firms large amounts of money. And so if they failed and those notes became worthless, those other firms would also have potentially be going bankrupt. That's why AIG was bailed out. So there is this contagion effect that happens when companies get too big to fail. And one of the ways that happens is they get so comfortable, whether it's through implicit bailouts from the Fed or an FDIC insurance, or just knowing that they've got buddies in Congress that'll make something happen for them. So they take all these risks that they otherwise wouldn't take without that safety net that was provided by regulation. And so they take risks they otherwise wouldn't take, because they're basically playing with other people's money. And so that's where the moral hazard comes in. So when you're regulating, the thing to keep in mind is that there's a sweet spot where you do snuff out the Ponzi schemes, and you do limit the fraud, and you do end whatever perverse practices are happening. But then you can overdo it and go beyond that scope and create market share, create monopolies, create cartels, create too big to fail firms that face that actually comes with a whole new set of risks because of the moral hazard,
right,
and the safety net that the safety net creates.
Absolutely. And also, like you mentioned earlier in the beginning, is that it stifles innovation. Overregulation can stifle innovation. And right now, blockchain and crypto, unlike the traditional markets that they have fractional reserves and lending and a different setup than the Luna UST crash, I would say that there's more to be understood. That's why education is so important. The way blockchain and crypto operates, the way it works, is so different than modern finance, traditional institutions, that there should be a level of education worldwide, before men and women come out with ways to regulate and direct the flow. I mean, it's important to understand how something works before determining how it should work moving forward. And
let's drill into that. What kind of education are we talking about? Because I completely agree with you, and I'd like to highlight some examples. To be timely, it'd be great. I'd like to have some chain analysis on the wallets and the exchanges that the actors that first attacked UST in that moment, where that 3-curve liquidity pool, that 3-asset 3-pool on Curve was low on liquidity. They took that moment to attack, and then they made a bunch of money, and they pulled it out into different exchanges through different wallets. I'd love to know who those people are. The crypto community would love to know who that is. There's a role for regulators in answering those questions.
And they have and those are the people that have the tools. I can't call up someone at the LMNOP, ABC, SEC and say, hey, what's going on? This UST $15 billion market crash that was caused by someone or some people moving around hundreds of millions of dollars. I want to know who this is, especially if they're using protocols that go through centralized exchanges like Coinbase or
Gemini or wherever.
Gemini, any of these, they're all AML KYC. So this is where, like you said, regulators can come in and help the space grow in a healthy way. We understand the mechanics that caused the crash. That's no big deal. It rippled out and affected, obviously, those of us who were involved in Luna and the IBC and others, where it rippled out as collateral. But in the grand scheme of crypto and blockchain and Bitcoin, the market, it was a blip on the screen.
It's not Lehman Brothers.
It wasn't Lehman Brothers in crypto, nor was it to the anywhere close to being a threat to the markets in general. So it was it was an ouchy learning experience, and ouchy more for some than others. But either way, stable coins are not all equal. So here's a segue. That's Luna UST, which was this decentralized attempt at staying pegged to the US dollar. And I guess what a stable coin is a blockchain crypto asset that in theory is stable or pegged, in this case, to the US dollar, which is the measure of price stability, I would say. Although you can say they're stable coins with the euro and the pound, and they exist and can exist in other currencies. But the idea is knowing that blockchain and crypto is volatile, and some people would like to trade in and out of the volatile positions. Stable coins offer that place of refuge. They offer that way to hedge against the volatility. So stable coins aren't for everybody. There are some people who set it and forget it and aren't into the trading and maximizing. They just ride the flows up and down and see you in 2 years, 3 years, 4 years, 5 years. And then there are those who actively manage positions in which to come in and out of Bitcoin or Ethereum or any other token and say, I want to kind of capitalize on the inflows and outflows. So
Yeah,
stable coins are that, but not all stable coins are made the same.
that's right. Well, we clearly saw that with with Luna UST.
We did.
So
And
I guess
so
go
what
ahead.
makes, well, I was to say, so we know the Luna UST was that decentralized mechanism, didn't work out, but USDC, when we look at USDC, Tether, they're also called stable coins. Do they pose the same risk as Luna? And the
No.
answer is obviously no, but why is that? Why do these two not run that risk of depegging? And would you say that in the world of regulation, that these two tokens or coins might fit the bill of being required
Yeah,
for regulation?
sure. Yeah, I think that's kind of what where we're heading is, well, first let's answer the question. Are they liable to be depegged in the same way that Luna UST? And the answer is no. There's been moments where Tether has come down a penny. You know, especially when this whole thing with Luna UST was happening, there was definitely a is Tether depegging narrative flowing around Twitter. And but no, that the reason is because they have actual collateral that is parked at financial institutions, and it's dollar-based collateral. So it's like dollar deposits, it's bonds. I'm not sure of all the different mechanisms of how what financial products they use, but you can look that up. It's publicly
We did a
available
video on
information.
this many months ago when they came
Yeah,
out with an article from an audit, but like you're saying,
right. But they're audited and they're collateralized.
so it's not a crypto blockchain in the sense that they operate in some decentralized way. They are on the blockchain, and people have the ability to use them.
They're basically digital dollars.
They're basically digital dollars, and they provide a service. And because of that, they've got that collateral to back it up. And therefore, I could say, well, like we were talking about regulation, if people are claiming to have collateral to back up a stable coin, a digital dollar, that would make sense to have an oversight, a regulation to make sure that what they say they have that to me.
Especially if that collateral is made up of dollar denominated assets that are traditional financial assets, not some kind of a crypto version or analog, but they're actually made up, they're collateralized by the very financial products that exist and dominate the traditional market. So it'd be really hard to have all your safety collateral be a traditional asset and then to claim you're decentralized and you shouldn't be subject to regulation. It's like, well, it's clearly this is a product, this is a financial product that people are, that there's a promise, there's a liability, there's collateral, there's assets, there's a company with a corporate identity, parking these things at traditional financial institutions. So it's really very much a Wall Street kind of creation, I would say, more than a crypto, but it does use the blockchain. So it does have a blockchain interface, but it still feels like a product of the traditional old financial, the legacy financial system.
So I have a question for you. We look at things like FRAX or DAI or other experiments in blockchain that don't claim to have any dollar for dollar collateral assets in a bank backing it up to maintain that. And our mathematical attempts, algorithmic attempts with collateral, there are actually collateral based. We did a video on Blindex, which is a DApp built on Bitcoin, and there's FRAX, which is built on Ethereum, and there are some others that
Shade
we'll talk about as well. So
get to them in a minute.
What do you think? Should regulators come?
I feel like
areas where there's experimentation going on and we don't yet know how these things work or are going to work out.
Yeah, in that context, I feel like this is still crypto. This is where the education. So if you got two choices, if we're looking at two broad choices, regulate, control through policy, or just try to educate. I feel like this class of stable coins you're talking about is we need to see the regulators take a hands-off approach. And if they see something in any of these projects that they think is wrong or is a mechanics that are similar to UST Luna, then by all means, like put that out there. You know, let's hear about it. Make a press release. Do a study. Publish it. But I think it's more on the education footing on that, because of the fact that the point we always make is this is an innovative space. We don't yet know exactly what the optimal crypto project should look like. And it's going to be a long time before we figure out if it is even possible to have a stable coin that's not backed by dollar assets. Like, that's still an open question. So I say let these experiments run, and leave space for experiments, because what happens is if you regulate that and you say, oh, these things are too much like Luna, Terra, then we might lose out on some really innovative ideas that we wouldn't otherwise have, and that could, you know, that's not good. It's good to have innovation, ideas, and technology. That's kind of that's what our economy thrives on. And if we're going to figure out a way to decentralize money and finance, it's going to be done through innovation and experimentation, not some wise people, not some class of technocrats saying, well, this is how it'll be, because what do they know, right?
I mean, and that's the point, is what do we know? What do they are we are them? This is a new technology, like the automobile replacing horse and buggy. And what does the regulator of horse and buggies know about transmissions and engine repair? And should they be in charge of regulating the growth of the automobile market? And that the idea is, we know that Bitcoin and blockchain completely removes counterfeit, which is something been a problem even in precious metals, but especially in fiat money has counterfeit been a huge problem over time. Well, Bitcoin makes counterfeit impossible. And there are other efficiency gains, or other major just technological.
There's the Cantillon effect.
The Cantillon effect was huge, and which we've talked about in a video as well. So the idea is that education comes because we would like to see regulation in the way that helps protect people and this technology flourish in the most way, not regulation just for the sake of stifling innovation and protecting industries that may not be as relevant. I mean, there's obviously still a huge need for people that are working in places of intermediaries and finance, and but clearly there's going to be a relief of labor and resources that are dedicated with this new technology. And crypto assets could disrupt the international financial system if they are not regulated, overseen, and interoperable in a consistent and appropriate manner across jurisdictions. Well, I mean, what do you say about crypto assets disrupting financial systems?
Well, you could read that in a couple different ways. You could read that disruption as being a good thing or a bad thing. And that's where this gets ambiguous, but they will disrupt the international financial system. The question is will that disruption occur quicker and to a greater extent by replacing a lot of these institutions? Or will it be something that only happens on the margins because these institutions have been able to strike back by limiting the innovation and limiting the reach and what can be done,
and absorbing it in such a way that you don't even know. It's like, oh, instead of Swift, it's Bitcoin running your transactions, but at the end of the day, you have no idea, and there's still people benefiting. And so we don't know how it turns out, but the technology, fire can be used to heat your home and cook your food, or if you put it in the wrong place, it could burn the house down. So just, it's understanding.
Well, the big takeaway I see from some of these articles, I mean, we've gone through the first one about the G7. There's one talking about US Congress. And then there's another where the US Congress is discussing UST and the bank run scenario and
they actually published
what that means.
A few days afterwards, published a document that contains a rundown on algorithmic stable coins and points out key factors on UST. It came out a few days. They did this after it happened.
So quick.
It'd be nice to see things like this education coming out beforehand or awareness. But I suppose, like you said, even no matter where you're working, you're just learning about this. We're all learning this together. So
Yeah.
let's leave room to learn how it works before telling people how they're allowed to create and build with it.
And this is another interesting story. 44 central bankers from developing countries around the world heading to El Salvador to discuss Bitcoin and financial inclusion and what having Bitcoin as the legal tender involves, looks like, what are the challenges, what are the opportunities. They're learning how to get a wallet and trade and send, and so it's really interesting. It's like, okay, it's the people at the top of the elite legacy system are now kind of, you know, downloading wallets and learning about this technology and potentially seeing how they can also incorporate it into their financial systems. So that's very bullish.
You're seeing it coming from countries that generally areas that didn't have access to the best financial resources. And now they're more interested, whereas other countries, tier one, that have had the credit and the premium financial class sector economy growth going on, all that happened. They're like, well, we need to regulate. We'll take our time with it. We'll see how this works. We're good right now. In other countries, they're like, yeah, we need something because the inflation, because of other issues. It's always, you know, it's too volatile. Our currency is too volatile. And we're seeing this little meek shall inherit the earth kind of a thing, because it's beautiful to see where people are hungry for this knowledge and to learn and to adopt. Because for those of us who are learning this and excited about this, we do see Bitcoin as filling in all these spaces. I mean, at some point in time, all these countries will be colored in with orange and with an appreciation for blockchain and crypto. But you're seeing now at this time where there's a little bit more of an appreciation and a hunger for this technology. I mean, it's been known for a little while now, for a couple of years, that you go to places in Africa and the people there are already communicating in exchange of goods and services in Satoshis. Like they already can think in terms of Satoshis. So that's cool. It's cool to see it growing and spreading even more and more interest. And as you said, these central bankers, I mean, that is getting at the top tier when it comes to the financial class and money and banking. So interest there to ripple and spread down is.
One thing speaking of top tier in money and banking, it's a good segue. Talk about George Soros.
Oh yes,
it's a little bit of an aside, but it's directly relevant to what we're talking about. But if you're not familiar, okay, go ahead.
No, I was just saying it is because people in the earlier article, regulators or bankers worldwide say, oh, the UST raises an eyebrow because of this. But the reality is is regulation really the problem? Or even in a world of regulating, do we still see Enrons and Lehman Brothers and even depegging events?
Right. One of the most famous depegging events of all time, I would say here. This has been talked about and will be talked about for generations. So what happened? This is why, one of the reasons why George Soros is such a hated individual in so many circles, is this did not win him many friends. But essentially what happened is in the early 90s, Great Britain moved, they were, the beginning of the EU was forming. The euro had not yet formed, but there was this ERM market agreement essentially that Britain joined. And one of the conditions on joining it was that they had to keep their exchange rate within a certain bound. And it was in terms of the Deutschmark, because the German economy, even today, was one of the strongest economies and one of the strongest currencies in Europe. So they had to maintain this exchange rate with the Deutschmark within a certain bound, looks like plus or minus 6%. And within that bound, it would trade and it would be acceptable, and the exchange rate would be fine. But beyond that bound, it would violate the terms of their agreement, right? So what happened is that the pound was basically struggling to be was overvalued, right? The zone where the peg occupied was at a greater valuation than the pound really had. They had created more pounds and they weakened the pound, and the British economy was not as strong to maintain the peg. So there was a lot of doubt whether or not this would hold. And so as the pound started to trade lower and lower and lower, it started to come close to that lower bound. And so speculators thought, well, they probably aren't going to be able to hold the peg. So what Soros did was he borrowed a bunch of pounds, sold them, and then took a giant short position on the pound, and that made it weaker, right? So then the British central bank had to then go and purchase the pound using its foreign exchange reserves. They had dollars and Deutschmarks and other foreign currencies in reserve. They were taking those foreign exchange reserves that they had received through trade, through exporting, and they were using them to purchase the pound on the international market, which would lower those foreign currencies, and that would raise the pound, right? Taking the pound, getting a bid or a demand for the pound would push it up. And they did this, and it basically, the market Soros, his position, he just doubled down on it and just kept shorting the pound. And the rest of the market participants saw what was happening, and the people who jumped on board. And eventually the British ran out of foreign exchange reserves. They could not artificially pump up the pound any longer because they had just ran out of ammo, essentially. And so at that point, they had to let the pound float, which means break the peg and float freely against other currencies. And this was a big moment where basically George Soros made like almost $1 billion, and the British central bank had been embarrassed and basically bankrupted in terms of their foreign exchange reserves. And this is the classic bank run on a peg.
And this was done in this is way before Bitcoin and crypto ever existed. Traditional financial markets, the bank, this is a very, very heavily regulated market. The market was created by regulations. The money itself, fiat, is a legal decree, is a legal tender that's created by regulations. So the idea is that, well, if bankers created tender and the laws that regulate how that tender is exchanged, and they're in control of the markets, and the events still happen, how is the idea of regulators of traditional banking markets stepping in to create some kind of a regulation framework going to be beneficial to blockchain and crypto when men and women barely even know what blockchain and crypto is, in banking industry included? So it's like, it feels that some level of regulation, obviously in areas where you've got Coinbases and Krakens and Geminis and the
Tethers
and Tethers, where there's audits and collateral claimed by institutions that are connected to the traditional financial system. So that makes perfect sense. But I feel that as early as we are, as just men and women learning this new technology, a level of humility and openness and excitement about this new technology worldwide, wherever you are, should be, promoted and adopted to let it flourish. And even there seems to be this talk of regulation and taxation, which clearly needs to happen in many areas where it's due. But there are also areas where men and women have not been protected by FDIC insurance or the benefits of security and oversight and regulation, have lost a lot in things like UST or private key storage or other things,
Or how about the YouTube and Twitter scams? Send me a Bitcoin, I'll send you 10 Bitcoin back, that kind of stuff.
Those have been around for years, and they still somehow proliferate on centralized platforms like YouTube. So, there are definitely some areas to help protect the consumer and to help regulate. But in other areas, I feel like there should be an acceptance that this is all, people have taken risks all over the world to help build these communities, not knowing what's going to happen. So I feel there's a grace period, some kind of a grace zone, instead of people saying, well, this is what we're going to do with everyone. It's like, well, why don't we figure out what everyone is building and what's being done first, and then decide together.
Well, it's another way to say it is there are some novel projects happening as we learn from the UST Luna debacle. There's projects that are changing how they're collateralized or over collateralized, but they're not parking dollar denominated assets at financial institutions. They're using a combination of non-correlated capital, like in the example of Shade, they're using Bitcoin. They're letting USDC come involved, and they're moving beyond just because they're on the secret network. So they're not just going to collateralize with secret token, right? So they're looking beyond the super correlated assets and they're also looking beyond just the dollar, right? They're using a whole basket of currencies, including gold and others,
as an index. We've talked about them before. We're going to go into a deep dive and go into the details of the latest Shade and Silk, but this is beautiful. They've learned from what's happened and they adapt and overcome, over collateralized, modular stability, redemption and issuance. This is something, as you mentioned, this is not pegged to the dollar. It's not pegged to the euro. It's not pegged to any one currency, yet it's algorithmically designed to bring stability based upon the values of national currencies. And you mentioned not just fiat currency, Bitcoin and gold. So commodity in different sectors of the market. Very, very innovative, very interesting. And this is something that it's not claiming to have any US dollars or any type of peg to a specific fiat currency. This seems like a beautiful, decentralized, stable type coin, right? If there's that there's really no need for a regulation more than let's see how this operates and how it works.
Well, the risk is that these sort of things don't occur if we come and just overly and really hammer the stablecoin space as a whole and don't treat these different projects in different ways, because Tether and Shade are not the same. They shouldn't be. They are both stablecoins, but we shouldn't treat them the same. And we should also recognize that a softer touch is going to let this sort of stuff happen. We'll see things that work. We'll see things that don't, but we'll become a lot smarter and more intelligent. We'll have more knowledge going forward that would be lost without in a more regulated space, right?
I dig it, and it's brilliant that you mentioned that, because stablecoin, just because you hear the word stablecoin, and that's what's so nuanced and very tricky about this new technology, is that stablecoin for Luna UST versus Silk and Shade versus Tether or USDC are all three different models, or even Frax and Blindex. They're all different models trying to achieve some type of price stability on the blockchain. So the idea is that to regulate stable coins, the word is now trying to fit different technologies or applications under one house that really don't belong together. That's like making a law again, regulating on staking, but recognizing that staking on secret network to help secure the network and support its ecosystem
versus like staking on Anchor.
Staking on Anchor, right? Or versus exactly right. Or because even and I would even say staking Hex or a time value currency, because now you look at something like that, and that stake doesn't secure the network. And that type of project is completely decentralized by code and
Right.
secure, but it's an application built on a chain. So when we talk about, regulation and understanding, there's a different world when it comes to the layer one blockchains and their levels of decentralization, and the applications, the tokens built. Is it a DAO that's alive and organic that people vote on? What level of decentralization needs to exist to be able to operate freely?
I see an argument. I'm not planting a flag in the sand or drawing any firm lines, but I see an argument that goes along the lines of, the more of you have a team, a roadmap, a develop, a core group of paid people that manage the project, and it's still going to be in development. I feel like that's closer to like an ICO sort of thing, where you're getting close to a hedge fund or security or a company, right?
Right.
It's centralized to some degree. And I could see an argument for regulating those kinds of projects. But I also say at the same time, the projects that are complete, that's just a blockchain that runs, that doesn't require any development further. There's no roadmap, there's no team tokens. It's just it's a complete project that's truly decentralized, like Bitcoin or Ethereum. I see how that, like you say, there should be a space left for those sorts of things to kind of more or less operate unencumbered, and let's regulate the spaces that do have the points of failure, whether it's or do have central control with a team or a foundation or something, because that makes a lot more sense. It's more like a company.
And also, you look at United States or Brazil or China, typically organizations were funded, VCs were in jurisdictions, but you have blockchain crypto projects, applications that are created in a decentralized, without a location, and are created by people and supported by participants worldwide. So I feel like whatever regulation comes about needs to acknowledge the openness, because these systems were designed, many, to bring opportunities to those who didn't have opportunities before, banking the unbanked. So that whatever worldwide regulation comes through, it needs to be open to allowing someone who grabs a phone in a country in Africa or South America or North America or China, Asia, wherever you're at, and be able to participate and join the ecosystem
with limited barriers to entry, right?
With limited barriers to entry, because it was those barriers to entry that prevented a lot of.
We're trying to get past anyway.
Right. That's one of the main things. So, but to protect people from, having their value being rug pulled, so to speak, in crypto and seeing a crash.
When BitConnect was going.
And I would say right now, there's a beautiful thing about the men and women who are regulators in the world, because if you're a regulator right now in central banks or whatever bank, and you pour through these charts and numbers and you understand banking and finance, we need you. We need you, because you're the same person who's going to be great at learning blockchain and crypto and what's being built there, and pouring through those charts and numbers and seeing what works and what doesn't, how we can make it better. That's what's beautiful about this technology, is there are many people from different backgrounds, whether it's in computing and coding or in banking, finance, or others, that can see blockchain and crypto taking it to the next level. And we need you with your knowledge to help get it there and make it happen in a safe, ethical, equitable way.
Harmonious way.
I dig it. Did we cover pretty much? I mean, we've gone through a lot. We'll do some more, but regulation, education, obviously there's a place for regulation, and those people in the world of regulating would know more than anyone how to spot out nefarious activity. And like you mentioned, I leave it on this note. What a great idea to put out there to those people in those positions now, to take a look, since UST brought up such I raised an eyebrow in traditional financial markets. Let's go chain analysis. Let's take a look through these companies and let's make it transparent, because blockchain and crypto is all about security through transparency. Let the people know, let the crypto community and financial communities know who was the George Soros behind this maneuver, and
Right.
we might.
That's need to know information.
I think. But yeah, until the next time, hope you learned something. You know what to do: subscribe, notification bell, thumbs up, drop a comment. And we've got some other stuff. The blockchain continues to innovate. That's why we take the macro look. Prices may collapse for weeks and months and a year or 2 or 3, who knows? But we do know that when the markets return bullish again and the world's ready to continue building and blockchain Web 3.0, a lot is going to be built here. So find those projects that are still developing and adding value. And when the bulls return, we know that those projects have the best chances, the opportunities of flourishing. I know, Jacob, you have found some awesome projects that you've been hammering out lately when it comes to communication, decentralized communication, private decentralized communication, and how to build those networks and participate. So
oh yeah, gotta stay up on it, the crypto markets, especially when it's bleeding.
yep, that's where you find the opportunities, and also on this channel. So until the next time, red or green and everything in between, have a beautiful day. Namaste, y'all.